Well, it gives me great pleasure now to bring on board Jonathan Garner, Chief Asia Emerging Market Strategist with Morgan Stanley. Jonathan, good morning. Thank you for joining us. Jonathan, if I refer to your last notes available in the public domain, your note in the month of November, you are overweight India. However, you feel that the H1 first half could be challenging one for emerging markets. Could you like to elaborate more on that?
Yes, thanks for having me on. So India is our largest overweight. It's a market that we have preferred over the last 2+ years, and we're certainly going into 2024 bullish. I think the rationale for that is superior GDP growth, nominal GDP growth of probably 12 or 13% over the next couple of years, and superior earnings per share growth. If you go back to early 2021, so I guess sort of 3 years ago, India's earnings per share have compounded to the extent of 60% in US dollar terms. That compares with essentially zero for overall emerging markets and minus 20% for China. And so this ability of Indian companies to deliver sustained earnings growth is extremely important for our bullish recommendation on the market.
Jonathan, given that we are at the peak of the interest rate cycle in US and the US 10-year, which is the most important indicator of which way flows would move, if the 10-year paper peaks out closer to 5 or 5.25, what implications do you think that will have for emerging markets in 2024?
Well, we think US 10-year yields have already peaked for this cycle, and they've started to fall. Disinflationary process gets going globally. What's remarkable about India is, compared to previous Fed cycles, how well India did, which is testament to a much improved current account and fiscal position. So we had very limited volatility in the exchange rate for India throughout the Fed hike cycle compared to what we've seen historically. As the Fed begins to cut interest rates by the mid-year of next year, we would expect the RBI to be broadly following the same pattern of interest rate reduction, not dramatic interest rate reduction, but that will be somewhat supportive to the equity market. But I want to emphasize monetary policy here, either overseas or in India, is not as important as GDP growth and earnings growth.
Jonathan, what is your understanding of India positioning by global investors? If the script moves as per what you've indicated in terms of GDP growth and in terms of earnings growth, do you think India actually could move from neutral to overweight positioning in 24?
Well, India is outperforming so strongly that many clients are chasing a moving target as India's weight in the EM index is rising significantly. At the moment, they're broadly neutral versus that rising benchmark weight. That's within the specialist EM and Asia ex-Japan universe. But what we are seeing is global investors starting to move into the Indian market for the first time. And that's really following the FDI and portfolio equity flows, which are also far more significant than in the past into India. So that's an exciting new development, truly global equity funds starting to add exposure to India.
So Jonathan, for a global asset allocator, if I may paint the picture is go towards China, which is cheap and has underperformed but has underlying risk, or go to India, which is where growth is visible, earnings are decent, but it is also trading above its historical averages. Do you think it's a bit of a conundrum and a lot of dilemma for global investors now to choose between India and China?
Well, our view is quite clear. We strongly prefer India to China. We expect Chinese nominal GDP growth to be less than half that of India next year, to disappoint consensus again below 5%. We actually are starting to see the currency becoming more volatile. And the ability of China to generate compound earnings per share growth is quite limited. Corporate return on equity has been falling relative to India and other emerging markets for some time. So we would not recommend a contrarian shift back towards China. We would stay overweight India, and we think India will outperform China for a fourth straight year next year, which is unprecedented.
Jonathan, I'm not drawing you toward what the importance of election cycle is. I know Morgan Stanley does not comment on election cycle, but purely in terms of understanding the flows here, do you think if there is a strong verdict which markets like, the flows into market like India post the central election cycle will actually increase?
Well, we don't comment on elections, as you mentioned. Our Sensex target is 74,000 currently. We think that's relatively easily achievable. Obviously, we'll watch what happens during the election process, and in particular, look at the policy framework. But beyond that, I can't make any comment.
Jonathan, what to your mind will be the biggest moving part for 2024? And just to give a backgrounder for the benefit of our viewers, the biggest moving part in 2022 and 23 was US interest rate cycle. It was geopolitical issues. It was uptick in inflation. What to your mind are the big moving parts for 2024?
Well, all of those are of interest, but again, they're not as important as underlying economic growth. So if you look at India or indeed Japan, that we also favor within our coverage, what's happened is a strong nominal GDP growth story has emerged in both India and Japan, domestically driven. A virtuous circle exists with that, corporate earnings, return on equity, and increased interest in the stock market. And that is ultimately far more important than things like the US Federal Reserve cycle for the performance of equities. And we expect both those two large markets in Asia to outperform again next year. And it's part of what we call a new era in Asian investing, led at one end of the GDP per capita spectrum by Japan and at the other end by India.
Jonathan, if one has to use the recent drop in the US 10-year paper and the decline in crude as a benchmark, is that a canary in a coal mine which is telling us 2024 we could have recession in developed markets? Is that a fear? Is that a valid fear?
That's not our base case view. We do think, however, that US growth is slowing currently, and that goes back to what we said earlier in this interview about the peak for US 10-year yields is probably now lies behind us. For India, lower oil prices traditionally help in relation to the balance of payments. And remember that though there are some sectors in India that have exposure to the US economic cycle, India as a whole is a market where the earnings are much more driven by domestic growth. And within the Indian market, we strongly prefer financials, that you were talking about on your show earlier on. Had a good week last week, and we also prefer industrials, domestic industrials, and domestic consumer discretionary. So we are very focused on domestic India growth within our recommendations.
What is your understanding of the earnings cycle curve in India? At what stage the earnings cycle is? Let's say if the earnings cycle started in 2021 post the COVID flush out. At what stage the earnings cycle currently is in?
Obviously, we work closely with our colleague Ritam Desai and his team in India. I would say that we're at the most midway through, and that it's probably a long earnings cycle this time around. Remember that in terms of thinking about long waves, the scale of foreign direct investment and private equity commitment in India is unprecedented, and that's driving an improved quality of growth and sustainability of economic growth. So it's probably a long earnings upcycle that we're looking at here.
Jonathan, if I take a leaf out of your answer, you said that if you have to prioritize, you would prioritize GDP growth and earnings to understand the future return of a country. But where does valuation fit in? When you have to map a country, you have to look at GDP growth, valuations, and earnings growth. Where does India fit in, both in terms of relative and absolute valuations?
Well, we always think in valuation terms relative to the return on equity and the earnings growth. And so, yes, India is on a growth multiple, if you want to put it that way. Depending on how far out you look, it's probably high teens forward PE on a 2-year forward basis. But that's not a particular problem with the scale of earnings per share growth that we've been talking about. As I said, in dollar terms, compounding, closer to 20% over the last 2 to 3 years. And so we are quite relaxed about that, both in absolute and relative terms.
There are a lot of things which would be at play, Jonathan, in 2024 for India. Again, at the risk of repeating myself, I'm using the word elections for the benefit of our viewers, but there's also a bond inclusion which will happen after JP Morgan. There also would be a lot of other such factors which would be at play. So do you think 2024, in a sense, the stars are aligned for Indian economy and Indian markets? If things go in the right way, they can just be the breakout market?
Well, as I say, we've been consistently overweight India with a few kind of interruptions along the way, but the outlook is very bullish. It is part of this new era of Asian investing that we've written a lot about, and it's one of our key overweights for next year.
Maybe I'm trying to get some exciting word from you, Jonathan. You'll appreciate that being a television commentator. I'm just trying to get one more word apart from overweight from you. So, Jonathan, when it comes to your priority towards financials and domestic denominated, sectors, what about global denominated sectors? Could that be a spoiled spot? For example, pharma, IT, exporters.
Yeah, we are somewhat more cautious on those sectors, but that's only because of how bullish we are on domestic growth. There's nothing inherently specifically negative about them. But yes, we have to make space somewhere, and also defensive sectors within the market we would disfavor relative to financials, industrials, and consumer discretionary.
Jonathan, are you surprised with what a good year it's been? What a good year 2023 has been, from gold to Bitcoin, from AI-dominated stocks to emerging market equities. 2023 has been nothing short of a dream year, I guess.
Well, it has depended what asset class you buy. So yes, Japan equities FX hedge has done very well. That's been a key recommendation of ours, and India has done well. But if you look at Hong Kong or China or some other emerging markets, they are actually down for the year. So there's been very significant dispersion in performance this year.
So Jonathan, if inflation and interest rate tightening was the biggest talking point a year ago, 2 years ago, what do you think would be occupying everyone's mind space for 2024 at a global level?
Well, I don't think it's very sensible to invest on sort of broad concepts at a global level. As I just explained, the key to the performance in Asia this year has been to understand that Indian GDP growth was going to continue to power ahead and corporate earnings growth with it, whereas China, there was a lot of hopes around a China reopening trade this time a year ago, and that didn't pan out as people had expected. So I'm not a huge fan of investing in Asia based on broad concepts like global liquidity or the path of US interest rates. What's going on in Asia itself is far more important.
And final question, Jonathan. I know, we managed to squeeze this interview in between two meetings for you. In your assessment, 2024 and beyond, how much of money do you think could come back to emerging markets in general? Because if dollar is down, if interest rates are peaking out, if emerging market growth is superior, some would say that the money which moved from emerging markets to US, largely because of the interest rate cycle hike, that should also start reversing.
Well, our whole interview, we've talked about the fact that the emerging markets concept doesn't really work these days. We have highly divergent paths of GDP growth and earnings growth. And so in our coverage, Japan, which isn't an emerging market, has attracted about $70 billion of inflows. India, much less. But India's flows position on a go-forward basis is very bullish. And that's to do with Indian fundamentals, not US rate cycles. And likewise, outflows from other emerging markets, which are ongoing. There are quite large outflows ongoing from China. They're not driven by US interest rate cycles. They're driven by Chinese fundamentals.
Also true. And, I think we've revisited that point once again, because there is this whole, historic assumption with which macro allocators and at least a lot of our viewers think. So that's the reason why I guess, I revisited that point just to get clarity on that. Really appreciate your time, Jonathan.
Indeed.
When do we get to see you in India? Are you coming
Great.
next?
I'm certainly be in India a couple of times next year for sure.
Well, look forward to host you in a studio that time. Thank you very much.
Great. Thank you. Bye-bye.
All right. Let's get a move on then.